Cisco Systems is just off of a 52-week low. Look at our chart right here. We had a high of 64 in the last year, a low of 38.66, and we're currently at 41, so it's off a little bit off the low. Now, Cisco was the high-flying stock of the early 2000s. This is the stock that was, if you look at the articles, when it hit $500 billion in market cap, it was going to be the first company to hit $1 trillion. Guys, look at this. Current market cap, $170 billion. And if somebody had said, like somebody did, Warren Buffett did back in the late 90s, he said, this is not sustainable. People said he lost his way. He was wrong. A lot of the same things. I'm not comparing myself to Warren Buffett, but a lot of the same things that we hear today. Paul, you're wrong. You don't get it. $500 billion it hit in market cap 22 years ago, and it's now at 170. It still has not reached that low case. So look at the max chart. Look at this, guys. It has not even come close to meeting its previous high. All right, so just remember that. Now, let's go look at the financials of Cisco to understand that what we're buying when we buy a stock. We are buying a piece of a business. We are buying a future stream of cash flow. So, Cisco, we're going to use our 8-pillar process. The first thing I want to say to you, though, is look at this. Dividend yield, 3.7%. Pretty attractive. Now, remember, if you're new to this channel, you'll learn soon enough that I don't look at dividend yield and just assume it's safe. I compare the dividends paid to the free cash flow over the last 5 years, and I want it to be less than 50%. And right here, it's $6.22 billion, and the 5-year average free cash flow is $14 billion. So we're safe there according to this. Doesn't mean we're always going to be safe, but it's a nice thing to see that they can easily afford this dividend yield. All right, pillar number 1, we want the 5-year PE ratio under 22.5. Go right here to our main page, 18.76, check mark, okay? Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. Right over here, 5-year return on invested capital, 20.1%. This means that the company gets a high return on the money invested in the business. Now, I don't know what the return on invested capital was back in 2000, but Charlie Munger will say that even if you overpay a little bit for a company, the return you should get should be the return on invested capital. I don't know if I necessarily agree with that. Now, Charlie Munger is a much smarter human being than I am. So I don't know what he means because he currently owns Costco and he won't sell it. So would they have a pretty good return on invested capital? But what's overpaying how much? I have no idea. But the good news is they get good return on the money in the business. Okay, pillar number 3, very simply, we want revenue growth over the last 5 years. So we go to the income statement. 5 years ago, 49.33. Last year, 51.56. So there is revenue growth there. Not a lot. And one of the things I want to do is make sure that you realize that there could have been acquisitions along the way. So I'm going to go to the cash flow statement real quick, go down to the acquisitions line, and look at this. A lot of acquisitions in the last 5 years. They spent a lot of money. What is that? $12.5 billion. So a lot of their revenue growth is probably not natural organic revenue growth, probably through acquisitions, which I don't like as much, okay? Pillar number 4, very simply, I want income growth over the last 5 years. So I go back to the income statement, I scroll down a little bit. So it's a little bit of a fluke. They had $110 million in profit 5 years ago, $11.8 billion last year. But you can see from 9.6, 110, 11.6. They had some big write-off in that year that threw their entire profit off the charts. But look, very consistent profit over the last even 10 years. So I like this. I like consistent profit. Now, pillar number 5. This is the silent killer for investments. This is something that I really pushed on this channel since we started 2 years ago. The number of shares outstanding. We want that staying the same or going down. A lot of companies that are overpriced will issue shares, which I understand, in order to raise capital, because you'd rather raise capital on expensive shares than on debt. Now, the issue with that is it dilutes owners in the company. So if you buy a share today and the company issues more and more shares in the future, you still own one share, but now you're dividing that revenue and profit and cash flow amongst more owners than you originally signed up for. So we go down to the bottom of the income statement, at the very bottom right here. We go back to the end of the 6th year, 5 billion shares, 4.13 now. So that's a check mark. They are buying shares back. The 5-year PE, if you remember, is 18. So it seems to be a cheaper company. So I'm okay with them buying back shares. But the goal is that they buy back shares on very inexpensive shares. Okay? Now, pillar number 6 has to do with free cash flow. It has to go to debt. And debt works the exact same way with a company as it does with you individually. The more debt a company has, the harder it is for them to absorb bad times, right? That's always been the case with debt. Just like you at your home. If you and your neighbor have everything's the same, income level, blah, blah, but they have $10 million in debt, you have zero, who is more likely to absorb a job loss, a recession, things like that? You are, obviously. So how much is an adequate amount of debt for a company? Well, what I determined for myself is I go back to our main page. I look at our 5-year average free cash flow. In this case, it's $14 billion. I multiply that by 5. That's $70 billion. I want long-term liabilities to be under $70 billion. So I go to the balance sheet. I scroll down all the way to the bottom. Total long-term liabilities, guys, $28 billion. Almost 2/3 less than what we want. This is great. It's 60% less debt than we want. So this company, from a 500-foot view, looks like they have manageable debt. They can probably pay off their debt with 2 years of their free cash flow, which is great. Now, speaking of free cash flow, pillars 7 and 8 have to do with free cash flow. What is free cash flow? It's cash from operations less your capital expenditures. There are 5 things you can do with free cash flow. Buy back shares, pay down debt, reinvest back in yourself, issue dividends, or make acquisitions. Any combination of those. And we've seen that in the last 5 years, they've spent about $13 billion of their last, $70 billion in free cash flow buying new companies. They paid out dividends of $6 billion a year. So you can see they're using their free cash flow. All right. So let's go to the cash flow statement to determine what is going on here. So cash from operations less your capital expenditures. Your Uncle Paul at Everything Money has added this line to the financial statement, so you don't have to do as much work in the math area. And there'll be another shortcut here very shortly that I'm going to share with you. So 5 years ago, 12.8. Last year, 12.75. Slightly down, but still down nonetheless. That's an X. And our final metric, we want to come up with a value for the company based on the free cash flow. So we take their 5-year average free cash flow. We multiply it by 22.5. Just like the PE was 22.5, we want to determine what would that be for cash flow being 22.5 times, okay? So 14 times 22.5, 280 plus 28 plus 7. So 315. We want $315 billion market cap. And you guys, if you remember from the beginning of the video, the market cap was $170 billion. So this is a check mark there. Now, here's a shortcut for everything. 8 pillars tab. We have 1X, and that's the free cash flow. Now, does this mean go out and buy this thing? Absolutely not. Remember, the downsides to Cisco are the reason their revenue is growing is probably through acquisitions, which I don't really like that much. They are buying back shares, but not buying back a ton. So once this company drops more and more price, I do believe that Cisco will start buying back tons more shares. Okay, well, that's a positive for the company. But we have to determine what their future looks like. So let's go to the analyst estimates on the company. So right now on EPS, there's 30 analysts right now, and they're basically low mid-single digits in terms of year-over-year growth for earnings per share. Okay. Now for revenue, again, very slow, low single digits. I mean, this is not a growth company. So you have to make your money by buying the company super cheap and then buying back shares and paying you out dividends. That's how you're going to make your money, paying down debt. It's going to become a even better financially stable company as time goes on. So what's the appropriate amount to pay for Cisco? Well, that's why we created a stock analyzer tool. So let's go in here right now and make our assumptions about the future. Now remember, I'm going to be conservative. My goal is to be conservative, but not egregious. I mean, it's a healthy balance. You're going to disagree with some things. You're going to agree with some things. I don't blame you. The whole point of this tool is to make your assumptions about the future, and it'll show you what you should pay based on those assumptions and not including the balance sheet. So you might have completely different assumptions, and I don't blame you whatsoever. All right, so revenue growth. I'm actually going to go -1, 1, and 3. Now, 3 is kind of high, but remember, we're in an inflationary environment. Costs are going to go up. Revenue could go up with that. I only put 3 in because the organic growth seems to be a little bit lower there, and they probably are losing their natural organic growth. Profit margin. Now, last year was a big fluke year. 22.9% of the profit margin. I'm going to focus more on the 5 and 10-year numbers. So I'm going to go 17, 18, and 19. Free cash flow, a little bit higher. So I'm going to go with 24, 25.5, and 27. Now, PE and price of free cash flow. Guys, like I said, you got to buy this company cheap. The growth potential sucks. So you got to buy this company super cheap. I'm going to go with, surprisingly, 9, 11, and 13. 9, 11, and 13 on the price of free cash flow as well. Now, for desired return, this is where you get your margin of safety. Because if you invest in a long-term ETF, you're going to get 9 or 10%. So you need to get your margin of safety here. Now, for those of you who've watched our channel over and over, a lot of this on repeat, but I want you to remember, this is where the art of investing comes. This is the critical part of the entire process. You have to make your assumptions about the future. And since we don't know that, we are literally making guesses here. But we want to make reasonable guesses. The desired return is based on you. Now, for me, for a company like this, I sit there and say, okay, I don't like the fact that they're not growing naturally, organically. Does that mean that's going to be the next 10 years for them? Not necessarily. But I want to sit there and find a company, if I have to make my money based on them being smart with their capital, I want to get a higher return. So I'm thinking 12.5, 15, and 17.5. And the reason I go so high here is this revenue growth, I don't think is really that sustainable over 10 years. Is it possible? Sure. Is it probable? I don't know. This negative 1% I think is a little conservative, but still, I'd rather be that way. And I want to wait, especially in this environment where stocks are, especially tech stocks, have a lot of downward pressure on them financially. I'm going to sit here and be patient. So I'm hit the analyze button. Now remember, guys, there are going to be 6 numbers that pop up. 3 numbers, a low, middle, and high based on earnings multiple, and a low, middle, and high based on free cash flow. If they're all green, it doesn't mean go out and buy. It means go here and verify all this data. Do that multiple ways. Easiest way of which is join our community at everythingmoney.com. It's a great way to get access to thousands of people who have a similar mindset. The other thing is go on the internet, find the bull and bear cases, go out there and do your scuttlebutt research. Go find out what people are saying. Focus on people who have good foundational, fundamental reasons for hating or liking a stock. Don't just go out there and have some Yahoo message board saying, Cisco sucks, and that's it. Because those same people were the same people in 2000 who said, Cisco's going to the moon. Just make a rational decision based on the data out, all right? So, analyze button, scroll down. And guys, it's rough out there. 16 to 20, 20 to 30, and 18 to 25 is the midpoint. I have it on my watch list at $35. Why do I have it there? It doesn't mean I want to buy it at 35. I'm going to do more research and then sell puts on it to sell it at lower prices. So if you like this video, you need to watch the next one on margin of safety and how to use it to your advantage to be a successful investor. Thank you very much for your time.